You're watching The Northern Miner. I'm Devin Murrigan, and we're at the PDAC 2025 conference in Toronto. Joining me today is John McCluskey. He's the president and CEO of Alamos Gold, a company that he co-founded in 2003. He joins me now. John, thanks very much indeed for talking to us.
It's a pleasure. Thank you for having me.
Well, look, 2024 certainly has been a milestone year for gold production. And as a company, you exceeded the guidance. Can you tell me a little bit more about that?
It was a banner year for the company. We had record production. We were able to keep our costs in line. So we had record revenues, record earnings. I mean, we virtually broke records right across the board. And that was also augmented by an acquisition that we made mid-year. We acquired a company called Argonaut Gold, which brought in the Magino project, which happened to be sitting right on the doorstep of our Island Gold mine. And over the course of the latter part of the year and into this year, we've been integrating those two operations. And the upshot of it is that it adds another 100,000 ounces of annualized production once we get it operating to its nameplate capacity, and it takes us to the next level. So we've gone from aiming for a 500,000 ounce a year annual threshold to a 600,000 ounce a year annual threshold, and we're going to undergo a number of expansions over the course of the next few years that ultimately take us to 900,000 ounces a year.
That's interesting, and it segues very nicely into the next question about targets for 2025, because that backdrop feeds into your targets, doesn't it?
Indeed. We've managed to help ourselves on a number of fronts by acquiring the Argonaut operation. It effectively was benefiting from a brand new constructed mill. And so in addition to handling the 10,000 tons a day of ore that will be coming out of the Magino mine, ultimately we're expanding it, and we've been working on that for a number of months, and we're going to expand it so that we can close down the mill that we had at the Island Gold mine and effectively put all the ore through what was called the Magino mill, but ultimately will be the Island mill. And the integration of those two operations have a lot of net benefits, and one of them I could point out is milling costs right now at the Island mill are about $45 a ton, whereas at the Magino mill they're $20 a ton. So we're going to see a big cost reduction in terms of milling costs just by having all the mill feed go through the one mill. And by the time you add up other synergies, G&A and so forth, capital savings. For example, we were going to have to modify our Island mill in order to upgrade it to match a shaft sink that we're doing at Island right now. We don't have to do that anymore. We've effectively given ourselves a big head start on that front. We also were going to have to do a tailings lift for our Island operation. We don't have to do that now because we've basically we'll centralize all the tailings in the Magino facility, which has much more capacity than what we had. So from a variety of points of view, you add it all together and you get something like 500 million in synergies that we were able to achieve through the acquisition and ultimately through the integration.
Having said that, on the other end of the spectrum, you also have this Lynn Lake operations in Manitoba. There's expansions, there's developments there. Some people may be wondering what the timelines are like around that. Can you shed more light on that?
So we actually acquired Lynn Lake quite a while ago. We acquired it in 2016, January 2016, which was the very, very bottom of the gold cycle. Gold was under $1,100 an ounce at the time. And we've just shepherded that project along over the last, roughly 8 years, and by now we've more than doubled it in size. It was about 1.6 million ounces or so when we acquired it. Now it's roughly 3 million ounces in all categories. But we've also obtained all the permits for it. We negotiated impact benefit agreements with First Nations communities. Essentially everything that we needed to achieve in order to make a production decision on Lynn Lake, we were able to achieve that by the end of last year. So in this quarter, first quarter of 2025, we had our board meeting for the approval of the Lynn Lake project. Construction is starting this year. We will get going in earnest in the spring, and we expect that to be in operation and producing in 2028. So it's about roughly a $680 million capex to get that project built, but it's going to be a great producer for us. It'll in its first 5 years of production, it'll produce at an annualized rate of 200,000 ounces a year, and ultimately 175,000 ounce a year rate over its first 10 years. But ultimately that mine, based on known reserves, will continue for 27 years.
And that's interesting to have that in the offing, but also in your plate is the company permit that you received, approval permits for the Puerto del Aire project in Mexico, if I've got that name pronounced correctly. What does that timeline look like, and why is that so significant to you?
Well, we've been operating now in Mexico for 20 years, and virtually all of the operations since we went into production in 2005, they've come from open pits. And that's been very, very successful. Mulatos started out with a 6-year mine life. By now, we've been mining for how long? For just about 20 years. And we still see a good decade of production out in front of us. That production is essentially coming from an underground operation that we call Puerto del Aire. And in order to have a smooth transition from open pit operations, which will run out in 2027, to seamlessly go from open pit to underground operations, we more or less had to have the permit now, because that means we can go into construction, we need to build a new mill, we need to do all the underground development, and once that's done, and it's all integrated, effectively we'll be transitioning in a very smooth manner in 2027 from open pit to underground operations, and that's what we'll be doing at Mulatos going forward, right through 2035 and probably beyond.
John, as we wrap up, I want to ask you, with all of that on your plate and just looking so optimistically forward, you've got a very interesting macroeconomic landscape at the moment, right? And even if you look at the prices of commodities as well, just it's interesting indeed. How do you factor that to your strategy going forward?
Well, you know, having a gold price, the gold price today is just under $2,900 an ounce. That is exceptional. I haven't seen anything like that in my lifetime. And generally, when gold has gone on a run, if you go back to the first time it went on a real bull tear in the 1970s. It peaked at around $800 gold, and then it came down again, and we didn't see an $800 gold price until the 2000s. So we saw decades pass before we saw that type of gold price again. And then in 2011, it peaked again at $1,900 gold, very briefly, and then it pulled back again all the way to $1,100 gold. Well, it turned around and it started running again, arguably in about 2019. And here we are at $2,900 gold. We're at levels the gold market has never seen. And the question is this a sustainable gold price, or are we going to see a very sharp peak and see it crash down again? Well, if you've been in the gold mining industry as long as I have, you're conditioned to expect it to pull back. We all know it's a cycle. It never goes up in one straight line, and it never goes down in one straight line. It ultimately cycles like all waves do. This time, though, I think we're into a longer-term bull market for gold. And it's being driven by factors that we haven't seen in the past. For most of my career, central banks have been net sellers of gold. And they were selling it so aggressively in the 1990s that they had to bring in the Washington Agreement to create a more orderly market. What's different today? Central banks are buying gold. And we've seen the gold price effectively outpace the gold equities. So as well as we're doing, if we were enjoying the kind of valuations that gold producers typically see, we would be trading far higher than where you see us today on the same production that we have. Will we see that? I think we ultimately do, but essentially the market has to gain confidence that the gold prices that we're seeing now can be sustained. And I think that's going to happen. I mean, when gold crossed 2,000, for example, everybody was keeping their fingers crossed. Well, then it crossed 2,100, and then it crossed 2,200. Are we going to see it cross 2,300? It's more than likely. And it's because as you pointed out at the beginning, the macro picture, the backdrop to this market is a perfect setup for gold.
I'm going to leave it there. CEO of Alamos Gold, John McCluskey, thanks very much indeed for talking to us.